Hello and assalamu alaikum everyone. Starting today, we're gonna do the third chapter of Unit 5 Finance, that is cost and break even. In this chapter, we're gonna talk about, of course, cost, the type of cost, the types of cost, the uses of cost, the importance of accurate cost data, what is break even analysis, how do we construct break even charts, how do we use them, what are the benefits of using break even analysis, and its limitations as well. So that's the whole topic, the whole syllabus of this chapter. So without further ado, let's begin. In today's lecture, we're going to talk about what is cost, types of cost, and if we have enough time on hand, we'll also discuss some uses of cost. Cost, what is cost? What is the definition that strikes your mind when you hear the word cost? Basically, it's simply an expense paid by a business as a part of its trading. It can also be defined as the value which is incurred in order to produce goods and services so that the revenues can be generated for a business. So it's basically what is the value that is incurred by the business, what the value is incurred by the business that they use in order to produce the goods and services so that they can generate revenue. Basically, it's an expense that the business have to pay as part of their trading. Now, before moving on to the types of costs, I also want to highlight this small definition. What is a cost center? Because we're gonna use this term cost center when we discuss about certain types of costs. So, cost center is basically an area, department, or any other part of a business for which it is possible to calculate capital expenditure. So, it could be departments like, let's say, there's a car manufacturing department. There will be some parts, something like a particular sector that makes car components, a sector that a department that arranges those car components, a quality check sector as well, department as well. So there could be different departments. There are different departments in many business. So let's move on to the types of costs. First of all, we have the marginal cost. This cost is basically the extra unit of producing, the extra cost of producing one more unit of output. So let's use an example to explain this. So let's say we produce 100 units at a cost of $200. Okay, 100 units at a cost of $200. So what is the cost of producing one extra unit? So that is basically the average of the cost. That is, if 100 units take $200, if the cost for producing 100 units is $200, what will be the cost of producing one extra unit? Well, that will be the total cost of producing 100 units divided by the total units, that is $200 divided by $100. So that is basically your $2, right? So this $2 is basically your marginal cost, and it is basically used to identify if the business should produce more units or not, and when they want to produce some extra units. It's a very important. The basic uses of marginal cost is not that much detailed in our syllabus, but it is very important when we discuss in A2. We'll discuss more about the use in A2. In the AS syllabus, we just know what it basically is, the basic definition of it, and that's enough for your course. So fixed costs. Fixed costs are basically costs that do not vary in the short term, that do not vary with output in the short term, such as rents for premises, which are paid regardless of the fact that the production is taking place or not. So the rents for premises is a very good example that you can give for a fixed cost if the examiner asks you to define fixed cost and give some example. And another example could be like paying for rents of school during summer vacations. So the basic idea is that you have to pay some cost even if you're not producing anything, even if you're not generating some revenue. You still have to pay this cost even if you're not making any sales. Why is that? Because this cost is incurred nonetheless. It will stay same. Like the rents, you have to pay the rents even if you are not using the place that you have rented. The factory that you rented is not producing anything, but still you have rented that factory, right? So you still have to pay the rents, and the rent is generally fixed. And like for short term, let's say for 1 year, you have to pay $100 per month, so that rent is fixed per month, okay, until this 1 year. After 1 year it may change, but until 1 year for short term, the output, the cost will remain fixed and it will not vary with the level of output. That's the whole idea behind fixed costs. Next we have variable costs. These are costs that change or vary with output level, such as cost of materials used in making a computer. So you can say the more computers you have to make, the more materials will be bought, of course. So the more materials will be bought, that means you are taking in more costs. So these two are opposite in nature. Fixed costs are that are fixed, the cost that does not increase or decrease with the level of output in the short term for a certain period of time. But variable costs, they do change. There is variable cost per unit, it will be same for a short term, just like fixed cost, total fixed costs are same. So variable cost, let's say one part, one car, one particular component for a computer is $5, okay, so that is one component cost $5, so that cost is same. But if you're but how many of these components you buy depends on how much production level is, how much you are producing. So if you are producing 100 computers, so you will need to purchase those 100 components as well. So if the variable cost for each component was $5, so the total variable cost will be $5 multiplied by the level of output, that is 100 units, so $500. So I hope you get the idea. Once again, fixed cost is the cost that do not vary with the level of output. They remain same regardless of the fact if production is taking place or not. Variable costs do change with the level of output. The more you are producing, the more variable cost the business incurs. So, and do know that even if you are not producing anything, there will be some fixed cost, and if you are not producing anything, that means you won't have any variable cost. Your variable cost will also be zero if your output level is zero. Now that is clear, moving on, we have semi-variable costs. These have both a fixed and a variable element attached to it, so that's something different. Like these are semi-variable, they have fixed element as well as variable element. So a good example could be the basic wage of a salesperson. So of course, when you all must be familiar with salesperson, like those which sell you those life insurances. So the wage is fixed element, that okay, you will be paid, let's say $300 per month, and you will earn a commission for selling each extra unit, that is the variable element. So let's say they have the basic wage of $300, but for each policy, for each that life insurance that they are selling, they'll get $30 more. So if the person sells five life insurances, that means 5 times 30, that is $150 plus $300, that is $450. That will be the total cost incurred by the business and the salary of the person. So the cost that the business has to pay, because the salary of the person is also a cost for the business. So this cost is semi-variable. You have a fixed element as well as a variable element. Now this cost is a little tricky, in the sense that when we will be discussing about break-even charts, in break-even charts we draw fixed cost, we draw variable cost, and we draw the total. Using both of these, we draw the total cost, and also we also draw the number of sales that the business is making, the total revenue. So using that, we can identify, okay, what level of output will be required for the business to make profit. So in those break-even charts, we can't allocate these semi-variable costs, because what will we decide? Should we consider this as variable or fixed cost? We can't say it's semi-variable cost. We can't directly add semi-variable cost in the break-even chart. But I know that for some of you this might be confusing at this particular point, so you can just ignore about the break-even chart for now. You need to just know that what is the basic definition of semi-variable cost, that they have both fixed and variable element attached to it. The basic example they just gave of a basic wage of salesperson, that the basic wage is fixed element and the commission that they earn is the variable element. So that is the semi-variable cost for the business. If you have understood that much, that is okay. The other part about the break-even chart, you can forget that. We can discuss that when we talk about break-even chart, when we reach that point. The next two costs we have are direct and indirect costs. Now, direct costs, as the word suggests, direct, that costs that can clearly be identified with each unit of production and can be allocated to a cost center. So we earlier discussed what is cost center, that any area, department of a business that produces something, okay, an area, department, area, department which is possible, for which it is possible to calculate capital expenditure. So let's say you have factory A and factory B. Okay, I'll just write that down. Factory A, and we have a factory B. So we know that, okay, we are producing this product X. Okay, this product X is being produced in factory B. So whatever the cost will be of this product, it will be allocated to this particular factory. So another example that is given over here is that the wages of a garage mechanic. It's direct because the mechanic only works for one particular part, that is the garage. So let's say this is the garage and this is the mechanic. So since it is working only for this particular factory, the cost of this mechanic is also associated with this factory B. And another interesting thing about direct costs is that they tend to vary with the level of output and are normally, but not always, do remember, they are normally variable costs but not always variable costs. So this could also be a salesperson, and as we discussed that the salesperson costs are semi-variable costs, so it's not always variable costs. Generally it is variable costs but not always. Okay, then we have indirect costs, that costs that cannot be clearly identified with a unit of production and hence cannot be allocated directly to a cost center. These typically benefit multiple products and it is impractical to accurately trace them to individual products or departments. For example, the cost of cleaning a retail shop. So the basic idea behind indirect costs is that whatever you are, these costs are cannot be identified with the level, with a particular cost center, that you can't say what is the unit of production. Okay, if we are producing 100 units of production, 100 units, what is the cost attached to this, that particular cleaning. So हम कैसे बता सकते हैं कि भाई क्लीनिंग के जो है वो कॉस्ट कितनी है 100 यूनिट्स के साथ अटैच, हाउ मच कॉस्ट इज अटैच टू दैट. Like we can't allocate it to a cost center. We can't say, okay, if we are cleaning something, okay, how much of the cleaning cost of cleaning is incurred by each factory. We can't just say 50%, 50%, right? Because it is used by both of these departments, both of these factories, both of these cost centers. So we can't just say 50%, 50%, and we can't exactly measure how much cleaning is being done. So because of that, we can't clearly identify which cost center should be allocated how much cost. So that's why it's an indirect cost. But this X, let's say it was a salary or a product, basically the cost of making a computer component, you can directly allocate, okay, it's being manufactured in factory B, that's why it's that. Let's say there's some another product Y that is being manufactured in factory A, so that the cost of that product is allocated, it is allocated to this cost center, right? Okay, this department, what are the revenues will this department generate, the cost will be paid by this department, the cost for X will be paid by this department. But for the cleaning, how much cost will be paid by each department, we don't know, we can't clearly identify because it's an indirect cost. So it's indirect. Why? Because the cleaning cost cannot be allocated directly to any particular product of the retail shop. Indirect costs are also called overheads and are always fixed costs. This point is very important, that they are overheads, not that, but like they are always fixed costs. Direct costs are not always fixed costs, but generally they are variable costs. They are generally variable costs but not always variable costs. Like it could also be semi-variable costs, but these are always fixed costs. So do keep that in mind. Sorry, maybe like a little confusing for now, but you can just rewatch it and read them again to identify that what is the direct and indirect cost. Direct, that can be directly allocated to a particular cost center. Indirect, that cannot be particularly allocated to cost center. And that's all. Thanks for watching, and Allah Hafiz.